Hey everyone, I'm Juan.
And I'm Phoebe Todoroff.
And this is the video that I'm most excited to be rolling out today. Fannie Mae has just announced a new program that's going to allow you to fast track your way to wealth, because they're going to allow us with this new program for you to buy a duplex, a triplex, or a fourplex with only 5% down. This has never been the case. It's a new policy. We're excited. So let's hop right into it. Hey everyone, so we have some exciting news that was just announced a little bit about 4 weeks ago, and this new program is going to allow you, the buyer, the investor, to maybe buy your first property, your first investment property, or maybe buy more units. And so this new program is through Fannie Mae, and we'll get into who Fannie Mae is, but the one thing we love about it is they're offering like a new policy that they have never offered in the past. So why this impacts you is that you, the investor, you, the homeowner, can now buy a duplex, a triplex, or a fourplex with only 5% down. And again, this is offered through Fannie Mae, separate from FHA. We'll cover that as well. And so all this is going to do starting November 18th is allow you to buy a property with much less down than before. And so for anyone who's been following our channel, you know that it is our goal to teach you how to build wealth through apartment ownership. And this new loan program is going to get us there much sooner. So let's hop right into it. Phoebe, talk to us about what makes this program unique. Talk about Fannie Mae first, like so people kind of know who Fannie Mae is and why it matters and why do we hear it.
Okay, so Fannie Mae is a government-sponsored enterprise that purchases loans from lenders, freeing up additional funds so lenders can close more loans for more potential purchasers and people who want to refinance their properties.
And so this is a way that a government helps in facilitating keeping the economy going. So in the world of lending, right? So there's this banks, they go out, they give these loans. So whether it's single family homes or multifamily, they're out there giving loans, right? So they're lending their money, but then they're out of money. And so then the government's concerned, well, we need them to continue lending money. Why? Because there's this domino effect of when you lend money, someone's going to borrow, they're going to then renovate the property, they're going to hire contractors and roofers and plumbers and electricians, and then there's this trickle down effect on the economy of people spending money for the government. It's a good thing, it's good for all of us. Then that contractor goes out to the restaurants and he's buying stuff. So all this is a very good thing. So the reason why Fannie Mae exists is to replenish the funds for the banks then continue the process. So that's exactly the role that Fannie Mae is going to play. But Fannie Mae came out in October of 2023 and they said, for the first time ever, now, in the past, if you wanted to buy a duplex, a triplex, or a fourplex, and you came to us, and by the way, we sell a lot of those types of properties, and someone said, I'm going to live in the property, that down payment requirement under Fannie Mae type loans was anywhere between 15 and 25%.
Correct.
So Phoebe, like if we're looking at $1 million fourplex, kind of walk us through what those numbers look like of what someone had to have in the past and what they could borrow now.
Okay, so on $1 million previously, for 3 and 4 units, it was going to require 25% down, which is $250,000. And the additional requirement that Fannie Mae required on 3 to 4 unit properties was 6 months of your entire payment in a reserve account. So you had to have additional funds sitting in the bank to cover reserves. So now Fannie Mae on $1 million for an owner-occupied property, 3 and 4 units, allows you to put 5% down, which is only $50,000. And I say only, that's still quite a bit of money. However, it is significantly less than it was prior. So it opens up the opportunity for the first-time home buyer, the seasoned homeowner, the person who wants to buy a 4-unit property in a different area to live in it, to only have to put down 5% versus 25%.
So in this example, we're essentially saving $200,000. So I support all you folks, and you know that I'm a big fan of helping you get to your goals. And there's been this narrative that I hear over and over again, and people say, oh, you're so lucky you own rental units, or he's so lucky or she's so lucky. And I'm like, it's not luck. Okay, only a small percentage of people were given properties that were passed down. Okay, but a lot of the folks that we've been able to help, they are maybe the first ones in their family to buy their first multifamily, and none of that was luck. And here's a program where if you would have called us 6 months ago, we would have said, well, you're going to need $250,000 saved up. Okay, that is like breath, you're like, it takes away your breath. You're like, oh my God, how am I ever going to save $250,000? But now it's $50,000. Okay, that makes it, now listen, that's still a lot of money. We're not saying it's not. And again, for those of you watching, in Southern California, a fourplex is easily $1 million. In most cases, in fact, in Long Beach, the average sales price is 1.4 million. So, but in other places, you go to Ohio, you go to Texas, they're going to be much, much lower. I mean, you're looking at 300,000, 400,000. This is just an example, but 5% down allows you, it's really what it's done. It's opened up this window for you to take advantage of. And if anyone, for those folks watching and supporting our channel, this is meant for you. This is a program specifically for you. I mean, we were surprised when it was announced. Phoebe, talk about a few of the other requirements that Fannie Mae said, okay, hey, we have this new program. What are some of the requirements?
So first and foremost, the requirement is that it needs to be owner occupied. It needs to be purchased as the primary residence. So you as the buyer need to occupy a minimum of one of the units. So that's number one. Number two, they didn't stray away from their reserve requirements, even though it is owner occupied. They still require 6 months of your entire payment to be in a reserve account after the closing of escrow. But other than those two items, it's still a standard conventional purchase. You're just able to put less down on multifamily property, 2 to 4 units.
Someone might be wondering, do I need to have a job? What's my credit need to be? Okay. How do I know if I qualify? Like, what are some of the things that we would tell them?
Okay, so I mean, you definitely need to have income. Whether you are a W-2 wage earner or self-employed person, you need to have verified income that is sufficient to qualify for the mortgage. So that is a standard for all Fannie Mae loans, is they need to be qualified mortgages. The minimum credit score is going to be 620. The higher the credit score, the better the terms of your loan are going to be. And as far as your down payment, 5% needs to be put down, and you need to have 6 months of the entire payment in a reserve account.
Okay, let's talk about that just to kind of give a number. Okay, so let's just go back to the $1 million fourplex, 50% down. When you're talking about reserves, so what the bank wants to know is that if through this program, you're going to have this down payment, that we're not we're not going to deplete all the funds that you have. So let's just say that the mortgage is going to be around $7,000 more or less. I'm just kind of making that up.
Okay.
So let's just say that the mortgage for that fourplex is going to end up being $7,000. When Phoebe's talking about reserves, they want, you said 5 months of that, right? Six months. So 7,000 times 6.
It's 42,000.
Okay. So, okay. You're going to cut that. All right. So, okay. So what they're going to request for reserves is you got a $7,000 mortgage at 6 months. That's $42,000. So for those of you watching, we have $50,000 and another $42,000. Okay. So you kind of need to show that you have that. Okay. Some of it could be gift money, I'm sure.
Yeah, so the reserves can be used from a retirement account. So if you have a 401k, you have an IRA, you have some stock accounts, all of those assets that are in those accounts, if you're 100% vested, can be used as your reserve requirement. So if you've been at your job for 5 to 6 years, give or take, and you've been putting in a decent amount of money into your 401k, it's highly probable that you have enough assets in that 401k to cover that reserve requirement. You don't need to draw it out. You just need to prove that it's there with a statement, and you need to verify what your vested balance is in that account.
So what you're saying is, if there's a retirement account, you don't necessarily need to have the reserve, which in this case, the example we're using is $42,000. You don't need to have that in the bank as well.
Correct.
It could just be somewhere where they're like, okay, if they needed help, it's definitely there. Okay. One of the things that I am strongly recommending is if someone is looking to buy a home, and they're going to obviously go buy that home and live in it, this is a really good way to just get your first investment property. It's a very good way to just live in one of the units, rent out the others, get you the experience as a landlord. And the one thing that I know is that the learning curve for an apartment owner is very quick. All you need is to have one rental, to know what maintenance calls are like, to know what leasing is like, to know what it's like to dealing with tenants. And really quickly, you're like, hey, this is not that hard. I want to buy more. And I see this over and over again. And so for the people that sometimes we assume they're lucky, they're not that lucky, that they did it once and they realize this is a very simple business to own. And again, I've said time and time again, when you buy units, you're buying a business. There's income, there's expenses. It's an operation, but it's an operation that you don't have to work on every day. You could have a regular day job and do this on the side. And in most cases, there's wealth accumulation, meaning that you're gonna be wealthy from buying it. And there's also cash flow and a lot of tax benefits. And so for anyone who's thinking, Phoebe, if someone already has a house, so they own a house, they bought it, and now this program gets rolled out, and they're like, man, I want to go buy a fourplex because this is an easier way to get in a fourplex. Mm-hmm. Can they do that?
So they can. However, it needs to make sense. The program is for owner-occupied buyers only, borrowers only. And so if you currently own a single-family residence or you own a condo somewhere, and that's been your primary residence for the past few years, and you'd like to buy a fourplex, you need to demonstrate the owner occupancy probability of the new property, meaning the unit that you're going to move into, number one, needs to be larger than where you currently live now, or it needs to be in a better area than where you currently live now, a more desirable area, or it needs to be possibly closer to your job. And so an underwriter in Fannie Mae is going to look at those items to determine that, yes, it's highly probable, highly feasible that this borrower is going to occupy one of the units that's in that property as their primary residence. And it needs to make sense. It needs to make sense on paper.
Got it. So a lot of times people call us, they're like, well, can I get the loan and not live in it? And of course you cannot. That would be fraud. And so that's not what we're going to do. But if you're like, hey, we already own the house, we're going to rent it, which is a really good plan. Right. And we actually have the 5%. And there is a fourplex in a little closer to my job. All that really is very reasonable for someone to understand that you're going to live there and take on that property. In my world, I call it leverage, right? So if I'm able to buy $1 million property with 5% down, who's got the biggest risk? And the way I look at it is, well, the bank has the biggest risk. Yeah, you could say, yeah, but I'm the one paying the payment. They're lending you the majority of it. Right. And there's not many assets where you could do that, where I'm only putting 5% down and 95% of it is going to be funded by someone else outside of me. It's a terrific program. Phoebe, let's talk about, some people are going to be watching this and they're going to say, well, Juan, there's an FHA program and you could buy 2 to 3 to 4 units with as little as 3.5% down. What's the difference and what makes this program unique and I guess different from FHA?
So FHA is a government-sponsored agency. It's the Federal Housing Administration, and the FHA loans are governed and insured by the government, by HUD and the Federal Housing Administration. So they have typically slightly lower interest rates, slightly lower down payment. However, they have mortgage insurance. They have an upfront mortgage insurance premium and they have a monthly mortgage insurance premium, which may or may not be higher than the Fannie Mae program, depending on the terms of your loan. However, FHA also has their own guidelines because they are a government-sponsored agency, government entity, and their 3 to 4 unit guidelines can be much more strict than what Fannie Mae has, making a 3 to 4 unit property financed with an FHA loan highly unlikely in this area in this day. So
yeah, so let me talk about that, because a lot of people are calling us and they're saying, well, but Juan, I've watched your other videos and you said you could buy with FHA a 3 and 4 unit with as little as 3.5% down. I recommend you watch that video, which we'll pop that in the link. But in the past, if you called us and you said, in Southern California, I want to buy a fourplex, a 3 or 4 unit with under FHA, I'll tell you the stats. In Long Beach alone, if we go back 7 years, only six of all the sales. So I'm talking about out of 700 fourplex sales, okay, only 6 of them went FHA. That is the success rate is very, very low. So what was getting in the way? Well, under FHA, there was this massive hurdle. It was called a self-sufficiency test, which we cover heavily in this video. And what we were telling people, it's like, yes, FHA says you can buy a triplex or a fourplex, but then they give you this hurdle that is really, in most cases, impossible. So impossible that out of 700 plus sales, only 6 of those went FHA. So most times when people would call us, it was almost like, well, you can't buy a triplex or a fourplex. We're gonna maybe reset your expectations to a duplex because they did not require the self-sufficiency test at the duplex level. So before I guess lose you all in this conversation, traditionally FHA made it really hard for a 3 or a 4 unit loan. But we just finished explaining that Fannie Mae is not FHA. And Fannie Mae does not have the self-sufficiency test. So for all of the folks who have reached out or maybe watched that video and said, well, you know, Juan and the team at Sage Real Estate said that's really hard. That was really hard under the FHA program. Now we're talking Fannie Mae, and Fannie Mae has created this new program that is going to benefit you into getting in. Because now we don't have that roadblock. Of is it possible? Now it's like, not only is it possible, this is an opportune time to get into the market, and we'll talk about that as well. Phoebe, let's talk about 2 things. So let's talk about, someone might be wondering, hey, that's great. I'm glad that you know I could save up 5% and go buy my first multifamily unit coming into 2024. But how about the interest rates? I mean, people are concerned interest rates are high and they're afraid. And so here's what I hear. Interest rates are high, I'm just gonna wait. So talk about interest rates.
So yes, interest rates are high compared to what they've been for the last couple of years, and they're at an all-time high for the last 20 years. However, you know, the experts are forecasting that in the second quarter of next year, interest rates could possibly drop around 1%, making them, you know, hopefully be somewhere in the 6s, making it a little bit more affordable for someone to purchase their new or their next property. However, if that does happen, and when it does happen, it's going to open up the door to 1 million more people to qualify for the same type of mortgage that you would qualify now with a slightly higher interest rate. So we always talk about people who want to wait for the rates to drop. Well, when that happens, it's going to flood the market with additional buyers, making it more difficult to purchase that property because the competition is going to be so significant at that time. So we're always recommending, if you can afford it now, you love the property, you want to buy it now. When the rates drop, let's talk about a refinance.
Got it.
And take advantage of those lower interest rates when and if they do come down. So
where are the interest rates right now? So it's, for those watching, it's this December 2023. Where are interest rates more or less right now?
They're about 7.25%,
okay,
depending on the parameters of your situation and your purchase.
Got it. Okay, so what we're seeing. So let me just describe. Well, let me talk about the interest rates. And so just this week, on Monday, the Federal Reserve, on Tuesday they met, and they announced that they were going to slash the Federal Reserve rate 4 times throughout next year. So all of a sudden, everyone's thinking, oh my gosh, the interest rates are going to tumble back to the 3s. Not quite. Okay, so this is a new announcement. It's very good for the real estate market, both for sellers and for buyers, that the Federal Reserve has finally announced that they're going to, because this whole time we've been increasing interest rates. So this is the first time they've come out and that they're going to slash them. All this information came out, headlines on how it's going to drop. But what we're seeing, and what Phoebe just said, is that when they're talking about slashing, they're going to be dropped at very small levels. And some are saying that it won't be until the second quarter. Some are saying to the third quarter. And let me describe a word that is used in our industry and it just confuses people, and they call it basis points. It's going to drop 100 basis points. And just to simplify that, 100 basis points equates to 1%.
Correct.
So if it was 50 basis points, it's 0.5%. 25 basis points is 0.25%. So for some reason they use the word basis points, but just so you know, when we hear interest rates could drop in all of 2024. So here's what I want you guys to know. When we're hearing that they're going to drop multiple times, best case scenario from what we're hearing now, we're not forecasting this, but we are definitely following the data because it impacts our community, is that by the end of 2024, it's potential that the interest rates have dropped 100 basis points. So that's just 1%.
Correct.
So Phoebe just finished telling us that, hey, right now interest rates are 7.25, so they might drop down to 6.25. And I know that some of you would say, great, then I'm going to wait for them to be that low. And all Phoebe was saying is, well, if you wait, all the buyers right now that we work with, some of them are on the sidelines with their arms crossed. Okay, I'm not buying right now, Juan. Okay, and we could only convince so much. Okay, but the problem is when they see and they hear the headlines that interest rates are dropping, they're going to get off the sidelines. Now they're buying. Now they're competing against you. And all we're saying is, it's a competitive world. People want to build wealth. They know that the real estate route is one of the ways, if not, well, it really is the best way to create wealth. I mean, hands down, right? Because we all know that 90% of all millionaires made it through real estate. So people are going to want to invest. Now, right now, being that it's December, it's a holiday season, and we kind of know that interest rates are going to be dropping, Phoebe's saying, and I agree with her, get into the market now, sign up for that slightly higher interest rate, okay? And then when it's time to refinance, then we'll refinance later. So that is going to be our advice moving forward for buyers. We think it's a terrific time to buy. Now, a couple other things about the market. Sales are down, prices are down. This is the perfect time to get in. If you know, like a lot of the people that we know built their wealth through long-term ownership. Okay, hey, Juan and Phoebe, I've owned this for 20 years, and I'm so glad I bought 20 years ago. But the only way that you could ever say that, you yourself could say that, is if you bought now, and 20 years from now, you're then telling the younger generation, get into real estate as soon as you can. This new program allows you to get into the real estate as soon as you can, right? We're not saying it's easy. We're not saying it's not stressful. We're not saying there's decisions to be made, and there's sacrifices. Listen, to save up that down payment, you're gonna have to change a lifestyle to be able to save up the money, right? Correct. It's gonna have to happen, but we really believe this is the time to get in. And so, Phoebe, let's talk about, listen, I finished telling you that the average fourplex in Long Beach sells for $1.4 million. There are max loans, meaning that they're not going to lend $2 million on a fourplex under this new program, right? Because they're going to put the cap somewhere. So let's talk about what that looks like.
Yeah, so there are max loan limits that Fannie Mae publishes, and the max loan limit for a 4-unit property in LA and Orange County is going to be $1,396,800.
Got it. And then obviously the max loan limit for a triplex and a duplex is going to change. So
slightly decreases.
Depending on where you're at, feel free to reach out to us. I mean, as you know, we have nationwide affiliates. So even if you're not in our area, we would love to refer you to a multifamily specialist in your area, and make sure that the person you're hiring specializes in multifamily, and most realtors don't. So let's talk about, Phoebe, when did they roll this program out? Is it available for loans now, or when was the start date?
So the start date was officially November 18th. So the program has been live and running, and the first available day that they were able to start actually closing them was November 18th. There was some activity prior to them, but they could not close until November 18th. So it's active, it's live, and every lender has access to it.
Got it. Now, we've been talking about the benefits for the buyer. Mm-hmm. What are the benefits for the seller?
The benefits for the seller is that they have a larger pool of buyers that only require 5% down. So a seller is able to hopefully, possibly receive additional offers from a larger pool of buyers that now qualify with the lower down payment for the mortgage.
And that's correct. In the last 2 years, what we've seen at the multifamily level is that we've seen a slowdown. So there's been less sales. Properties have been sitting on the market much longer. And and they've been having to drop the price. And even us, I mean, we're a big listing brokerage company where we list a lot of properties, and we've had to adjust our prices. Now, why have we had to adjust? Well, the interest rates rose so quickly, caught a lot of people off guard. No one knew they were going to get that high that fast, that it forced the market to soften. And so for some of the sellers out there watching this video, this is amazing news for you. This is so good, because all of a sudden we went from someone needing to have up to 25% to buy your property to only 5%. I mean, and to Phoebe's point, this opens up big pool of buyers. It's going to be our job to make sure that the buyers know about this program. For the first time ever, Fannie Mae has rewritten their policy. Now they could buy that specific property. So this is, not only is it big for buyers, where they could finally get their foot in the door with their first investment property, or maybe their second or third, but for the sellers, it's amazing, because the sellers up until this point have been telling us, well, this is not a good time to sell from what I hear, which is not exactly the narrative that we believe and preach within our company. But I think heading into 2024, we're going to see, I hope, a lot of improvement. And so one of those things is this new program, getting the information out. And then also, again, this week alone, we got an amazing news that the Federal Reserve is going to be dropping their interest rates. And so all of these things are like the stars are aligning for you, the buyer, for the seller. And so if you have any questions, please give us a call. We're going to continue tracking this. Some of the details haven't really been flushed out exactly. Phoebe, let's talk about, before we wrap up, I want to talk about mortgage insurance, because traditionally, if you buy a property and you don't put in 20% down, you have to pay like insurance, right? Because the government doesn't want us to default on the loan, meaning like missed payments. And so talk about what mortgage insurance is like, and does that make the payment go up?
It does. So if you purchase a property with less than 20% down, your loan is going to have PMI, also known as private mortgage insurance, and that is paid monthly. So whether you use a conventional loan to buy your property through this new Fannie Mae program, or you utilize an FHA loan to buy your property, the monthly mortgage insurance premium is going to apply regardless of which loan you obtain.
You know, Phoebe, sometimes I talk to folks and they're like, well, I'm not going to buy something until I have 20% down, because there's no way I'll pay private mortgage insurance. And I've been doing this for over 20 years. I've owned multiple properties, and oftentimes I've paid PMI. And sometimes the cost of the PMI is outweighed by the investment success. What does that mean? Well, if the property, in some cases in Southern California, we're getting appreciation of like $60,000 a year. And we're over here complaining about the small mortgage insurance payment. Now, I'm not saying it's small, but when I compare apples to apples, I'd rather have that appreciation of the asset. You might be watching this video and say, Juan, properties are not appreciating right now, they're depreciating. And I'm going to say, well, the appreciation levels are going to be much smaller. But ultimately, like, listen, if a property only appreciates 1% to 2% a year, but in the long run, we're going to hold this for 20 years, you're going to have these years where they're going to appreciate, and ultimately, you know, more than the 1% or 2%. The average is actually 6.3% if we go back 30 years. And so all I'm saying is, the only way you're ever going to have an appreciating asset is by owning the asset. And so don't let the property mortgage insurance kind of stop you. I've just seen a lot of people use that rationale. I don't agree with that rationale. Clearly, if you have the 20%, use it. But if not, let's take advantage of this type of program. Phoebe, any closing thoughts before we wrap this up?
No.
So there you have it. So let's recap. This new program through Fannie Mae is going to allow you, the investor, if you live in one of the units, to buy a duplex, a triplex, or a fourplex. Never before did Fannie Mae have this type of program. You also don't have to meet the FHA requirement of the self-sufficiency test, which in most cases was the biggest roadblock and stop sign from preventing you on buying some units. Okay, so this really is this gateway of a faster way to fast track your success. So to learn more, please reach out to us. I want to thank our sponsor, Sage Trust Mortgage. You know, when you work with Sage Real Estate, we are in partnership with Sage Trust Mortgage. Sage Trust Mortgage is overseen by Phoebe. She specializes in multifamily loans. So please reach out to her with any loan questions. That's all for now. Make sure to like, comment, and subscribe. Until next time.